Welcome to Money and Markets Series 4, Lesson 1. This is a new ARC Series 1 built the arithmetic of money. Series 2 explored what happens when borrowers break promises. Series 3 showed how bonds are priced, how markets are structured, and what happens when short sellers get squeezed. Now, Series 4 looks inside the financial industry itself. Who runs it? Who regulates it? And who sets the rules that ripple through every interest rate you have ever seen? We start at the top. The central bank. Central banks are unlike any institution you have encountered so far. They do not take your deposits. They do not sell you a mortgage. They do not trade stocks for a commission. Instead, they set the conditions under which every other bank operates. And through those conditions, they shape the economy you live in. This lesson covers what central banks do, how they do it, and why their decisions affect the rate on your savings account, your mortgage, and the price of everything you buy. So, what is a central bank? A central bank is a financial institution whose job is to maintain stability and transparency for a country's economy. That is the official definition. But what does it mean in practice? 3 responsibilities. First, keep inflation in check. Prices should rise slowly and predictably, not spiral out of control. When you heard in Lesson 3 that inflation is a thief, the central bank is the institution tasked with catching that thief. Second, support maximum employment. Not by hiring people directly, but by creating conditions where businesses can grow and hire. Third, enforce healthy monetary policy. This means managing the supply of money and the cost of borrowing so the economy neither overheats nor stalls. These 3 goals often pull in different directions. Raising interest rates can slow inflation, but it also slows hiring. Lowering rates can boost employment, but it risks letting prices run away. Balancing those tensions is the central bank's core challenge. And every decision they make echoes through every financial product you have studied so far. The central bank's most visible tool is the policy rate. This is the interest rate at which commercial banks borrow from and lend to each other overnight. The central bank does not set your savings rate directly. Instead, it sets the rate at the very top of the chain, the rate that banks charge each other, and lets that rate filter down. Here is how the chain works. The central bank announces, the overnight rate is now 5%. That means if Bank A needs to borrow money from Bank B for one night, the cost is roughly 5% annualized. Bank A then decides what rate to charge you for a mortgage. It needs to cover its own borrowing cost, its operating expenses, and its profit margin. So your mortgage rate ends up at, say, 7.5%. Bank B decides what rate to offer you on a savings account. It can lend your deposit to other banks at 5%, so it offers you 3% and keeps the spread. 1 number at the top, 2 rates at the bottom. And the gap between them is the bank spread you learned about in Series 1, Lesson 6. The policy rate does not work in isolation. It flows through the economy in stages. Economists call this the transmission mechanism. Stage 1. The central bank raises the policy rate. Overnight borrowing between banks becomes more expensive. Stage 2. Banks pass the higher cost along. Mortgage rates rise. Business loan rates rise. Credit card rates rise. Borrowing becomes more expensive for everyone. Stage 3. When borrowing costs more, people borrow less. Fewer mortgages. Fewer car loans. Fewer business expansions. Spending slows. Stage 4. When spending slows, businesses sell less. They hire fewer workers. Wage growth cools. And with less money chasing goods, prices stop rising as fast. That is how raising the policy rate fights inflation. It does not delete money. It makes money more expensive to use. And when money is expensive to use, people use less of it. The reverse works too. Cut the rate, Borrowing gets cheaper, spending picks up, hiring accelerates, and the economy expands. But if you cut too much or hold rates too low for too long, inflation returns. The transmission mechanism is slow. It can take 6 to 18 months for a rate change to fully work through the economy. Central bankers are, by nature, patient. Central banks also watch two ultimate targets very closely, the inflation rate and the foreign exchange rate. The inflation target is usually explicit. The Federal Reserve in the United States targets 2%. The European Central Bank also targets 2%. The Bank of England, 2%. Why 2% and not 0? Because a small, predictable amount of inflation gives the economy room to adjust. Wages are sticky. They rarely go down. If inflation is 0 and the economy slows, employers cannot cut wages easily. With 2% inflation, real wages can fall without anyone seeing a pay cut on their statement. The foreign exchange rate is the second target, though most central banks are less explicit about it. A strong currency makes imports cheaper, which helps consumers. But it also makes exports more expensive, which hurts businesses that sell abroad. Central banks influence the exchange rate through the same tool, the policy rate. Higher rates attract foreign capital, which strengthens the currency. Lower rates have the opposite effect. These two targets, inflation and the exchange rate, are the compass points that guide every decision. Now let us put faces to the institution. The Federal Reserve, the Fed, is the central bank of the United States. Created in 1913 after a series of banking panics. Its chair is appointed by the president but operates independently. The Fed sets the federal funds rate, the overnight rate at which U.S. banks lend to each other. The European Central Bank, the ECB, manages monetary policy for the 20 countries that use the euro. Based in Frankfurt, its primary mandate is price stability, keeping inflation near 2%. It sets the main refinancing rate, which serves the same role as the federal funds rate. The Bank of England, the oldest central bank still in operation, founded in 1694. It sets the bank rate, the rate at which it lends to commercial banks. Different names, different histories, different structures, but the same core function: set the cost of overnight borrowing and let that rate cascade through the financial system. When you hear that the Fed raised rates by 25 basis points, that is 0.25% added to the overnight rate. Small numbers, enormous consequences. Why must central banks be independent? Imagine if the president or prime minister could set interest rates directly. An election is coming. Cutting rates would boost the economy in the short term, more jobs, more spending, more happy voters. The temptation to cut rates before an election would be enormous. But cutting rates at the wrong time fuels inflation. And inflation, once it takes hold, is painful to reverse. The cure, sharply higher rates, often causes a recession. This is why most modern central banks operate at arm's length from the government. The central bank's governor is appointed by political leaders, but the day-to-day rate decisions are made by a committee of economists and bankers who do not face elections. Independence is not absolute. Central banks are accountable to legislatures. They publish minutes, hold press conferences, and explain their reasoning. But the key decisions about rates are shielded from short-term political pressure. This arrangement is not perfect. Critics argue that unelected officials should not have this much power. Supporters argue that the alternative, politicians controlling rates, has been tried, and it reliably produces inflation. There is one more role that central banks play, one that only becomes visible in a crisis: lender of last resort. When a bank is in trouble, when depositors are lining up, when other banks refuse to lend to it, when the overnight market freezes, the central bank can step in and lend directly. Not because the troubled bank deserves it, but because letting it collapse might bring down healthy banks too. You saw this in Series 2, Lesson 5. After Bankhaus Herstatt collapsed in 1974, central banks coordinated through the Bank for International Settlements. The Bank of England ran Operation Lifeboat in secret to prevent a chain reaction. In 2008, the Fed and the ECB injected hundreds of billions into the banking system to prevent a total freeze. They bought assets that no one else would buy. They lent money when no one else would lend. This function is controversial. If banks know they will be rescued, they may take bigger risks, a problem economists call moral hazard. But in the middle of a crisis, the alternative to rescue is often collapse. And collapse is expensive for everyone. Let us connect this back to everything you already know. In Series 1, you learned that interest rates are the price of time. Now you know who sets the anchor for that price: the central bank. You learned that the yield curve reflects expectations about future rates. Those expectations are, in large part, expectations about what the central bank will do next. You learned that inflation erodes purchasing power. The central bank is the institution responsible for keeping inflation near its target. You learned that bank spreads are the gap between what banks pay depositors and what they charge borrowers. The central bank sets the floor under that gap. And in Series 2, you learned that the Basel Committee was born from a crisis. Central banks, specifically the G10 governors, created that committee. Modern banking regulation exists because central bankers decided it should. Every rate, every spread, every risk framework you have studied passes through the central bank at some point. It is the institution that ties the entire system together. For takeaways from this lesson: 1. A central bank maintains economic stability by managing inflation, supporting employment, and enforcing monetary policy. Its main tool is the policy rate, the overnight rate at which commercial banks borrow from each other. 2. The transmission mechanism carries the policy rate into your life. Higher policy rate means higher mortgage rates, higher loan rates, slower spending, and lower inflation. The process takes months, not days. 3. Central banks target inflation, usually 2%, and monitor the exchange rate. Both targets interact with the policy rate. 4. In a crisis, the central bank acts as lender of last resort, lending when no one else will. This function is essential, but comes with the risk of moral hazard. Next lesson, we step inside the banks themselves. Investment banks, the firms that underwrite securities, run IPOs, and advise on mergers. And commercial banks, the ones you actually walk into. What they do, how they overlap, and what happened when the wall between them came down. I will see you in Lesson 2.